Imagine a client sitting across from your desk. They've just been through a massive medical emergency with a family member, and on top of that emotional toll, they hand you a huge stack of hospital bills. Your job? To get them every single rupee of tax relief they are legally entitled to. Well, let's dive into this explainer covering the brand new provisions for claiming medical treatment deductions under the Income Tax Act 2025. Whether you're a chartered accountant, a tax professional, or a student getting to grips with this new legal landscape, nailing these specific nuances is absolutely critical. So let's address that very practical situation head on. How exactly do we navigate deductions for severe medical treatments under this new tax regime? Look, medical emergencies are stressful enough for our clients. As advisors, we've got to make sure the legitimate tax reliefs provided by the government are claimed smoothly, accurately, and without any compliance hiccups that could trigger a notice later on. Now, for all of you who've been practicing for a while, we can instantly anchor our understanding here. Think of the old, familiar Section 80 DDB from the 1961 Act. It's basically moved to a new home, Section 128 of the ITA 2025. The legislative intent? It's exactly the same. We are still providing relief for specified diseases, but the structural placement, and more importantly, the corresponding rule references have been completely modernized and streamlined. Here is our roadmap for today. 1. Section 21.8, the basics. 2. Breaking down the law. 3. Practical case study. 4. Compliance and common mistakes. And finally, 5. Summary and takeaways. All right, let's kick things off with Section 1, Section 128, the basics. So, who actually gets to use this? This is a crucial point regarding eligibility. Section 128 is specifically applicable only to resident individuals, either for themselves or their dependents, and to resident HUFs. That means non-residents, they cannot claim this deduction. It is a highly targeted relief measure explicitly designed to support resident taxpayers who are bearing the heavy financial brunt of specific severe medical treatments. Now, let's talk numbers. When looking at the absolute caps on this deduction, notice the enhanced 100,000 rupees limit. This is specifically designed to protect our senior citizens. For a normal individual or a non-senior dependent, the maximum allowable deduction is the amount actually paid, or 40,000 rupees, whichever is less. But if the patient undergoing the treatment is a senior citizen, that ceiling jumps all the way up to 100,000 rupees. This is a vital distinction you have to make right away when profiling your client's computation. Moving right along to Section 2, breaking down the law. Okay, let's look at this word dependent. Section 128 specifically borrows this definition from Section 127.9 to keep everything perfectly consistent across the new act. Now, a dependent isn't just anyone you happen to be supporting financially. Legally speaking, for an individual, it strictly means the spouse, children, parents, brothers, and sisters of the individual who are wholly or mainly dependent on them for support. For an HUF, it means any member of the family who is wholly or mainly dependent on that HUF. This brings us to a really important detail. Rule 62 of the Income Tax Rules 2026. The law clearly maps exact eligible diseases to precise medical specialists. You can't just attach a prescription from a general physician for cancer and expect to claim this deduction. No way. The law strictly mandates that for malignant cancers, that prescription must come from an oncologist. Neurological diseases, a neurologist. Urological disorders, a urologist. This type pairing is the government's way of ensuring the deduction is strictly utilized for the severe conditions it was originally intended for. Now, let's see how this works in the real world with Section 3, Practical Case Study. To calculate the deduction correctly, you've got to follow these steps sequentially. Think of it like a funnel. Step 1, note the total bill. Step 2, and this is huge, you must subtract any reimbursement from an employer or an insurer. Then, Step 3, you apply your 40,000 rupee or 1,000 rupee cap to whatever is left. Let's say a client brings you a hospital bill for 300,000 rupees for a senior citizen dependence and neurological treatment, but their health insurance covered 220,000 of it. You do not apply the cap to the gross bill. You first subtract that 220,000 rupee insurance payout, which leaves you with an out-of-pocket expense of 80,000 rupees. So here is the bottom line. Even if those out-of-pocket expenses for a senior citizen far exceed this amount after insurance, the absolute maximum allowable deduction firmly remains at 1,00,000 rupees. In our previous example, the out-of-pocket was 80,000 rupees. Since that is less than the 1 lakh cap for senior citizens, boom, the client deducts the full 80,000 rupees. But if their out-of-pocket had been, say, 1,50,000 rupees, they would be strictly capped right here at this 1,00,000 rupee limit. Let's pivot to Section 4, Compliance and Common Mistakes. Listen, your documentation has to be absolutely airtight here. Just getting a prescription isn't enough if the doctor doesn't hold a specific MD or equivalent qualification mandated by Rule 62. When preparing these files, we as tax professionals have to verify that the issuing doctor's degree matches the statutory requirement. Also, make sure you are tracking all insurance payouts, because the definition of insurer under the Insurance Act 1938 is applied very broadly here to capture all health policies.
And here is the biggest trap, the most frequent error practitioners make, claiming the gross expense without netting out the insurance payout. Imagine an assessee paid 50,000 rupees for a treatment but got 40,000 rupees back from their employer. Their actual deduction is only 10,000 rupees. Claiming the full 40,000 rupees statutory limit in this scenario is a direct violation of the Act. And trust me, it will trigger a mismatch the moment the employer reports that reimbursement.
The statute is completely unambiguous on this. Section 128(3) strictly prevents double dipping. You simply cannot get tax relief on money that you didn't actually lose because it was refunded to you by an insurance company or an employer. It's that simple. Finally, let's wrap this up with Section 5, Summary and Takeaways. Keep these 4 essential pillars of Section 128 in mind when you're advising clients or doing computations for the 2026-27 tax year. Remember the shift from ADD to B, rigidly apply the $40,000 and $100,000 ceilings, always check the specialist's qualifications against Rule 62, and whatever you do, don't forget to subtract those insurance payouts. But I'll leave you with this thought. As our tax structures become increasingly integrated with digital health records and employer portals, the real question is, are your clients' documentation practices robust enough to survive an automated scrutiny assessment under this new regime? Thank you for watching. Please like, subscribe, and share. This video is for educational purposes only and does not constitute professional advice. Tax laws are subject to amendments. Please consult your professional advisor before taking any action. This is an AI-generated educational video.